Hi guys, welcome back to our channel. In previous classes, we have completed this measurement, this recognition, initial cost and subsequent cost, and measurement and recognition. What are the element of cost involved in it? So, if you complete this, no measurement of cost is pending. There are two measurements identified by Ind AS 16. If we complete this, then we can go through these concepts. But before we complete this, we just revise the previous slides which we completed. We have completed this recognition criteria and also these what we include, what does not include, and then recognition conditions and how we recognize spare parts, and also what is the unit of measurement in those situations, and what would be the initial cost, and would we account those initial cost, and what is the future yielding, I mean the inspection cost and overall cost, and how would we recognize at initial stage. I mean at initial stage only we need to identify this. That is why I have included these concepts here. And then what is the example for that major inspections, and how would we depreciate and for them. So I have given two practical examples. And also at recognition, what are the measurement elements, like what is the element of cost and how would we include, and when we need to include them, and what is the initial cost. Initially we measure that cost. The revaluation method will come at measurement at after recognition, but measurement at recognition we should recognize that cost. And then what are the cost elements, and while we dismantling or removal or site restoration, if any of those, how would we account them. And then what are the main cost I mean indirect cost or cost for self constructed assets, or for any asset, if what it is taking minimum time to acquire it is for its intentional use. In those cases, how would we account those costs, and what are the testing costs, and how students will do mistakes, and all we discussed in the previous classes. We have discussed in the previous classes. And also what are the costs are not included in the PPE. These we should not include in the PPE. And self constructed asset, what are the additional costs we should include, and what are the incidental operations we should account as an PP, profit and loss account. You should not account this under the deduction in the PPE. And then when we stop the capitalization, when we cease the capitalization of the PPE, we have discussed in detail in the previous classes. So now today we will discuss this measurement of cost, and then acquisition of asset, any exchange for exchange of non-monetary or combined assets. So I will explain in detail. First, we will discuss about this payment under the normal credit behind. If you paid the particular transaction in the behind normal credit period. Say suppose if any vendor is able to give credit 30 or 60 days based on the relationship between the entity. So if that particular vendor able to give that credit, you give that this credit for 1 year, there would be something involved in this. Say suppose if you buy with normal credit conditions, he can provide this asset for 100 crores to you. But if you can't pay that 100 crores within his normal credit period, he has another offer. If you want to pay in 1 year, so he will give that same asset for 110 crore. So this extra 100, I mean extra 10 would be the calculation of finance cost. I hope it is yes. It is not hope. Ind AS is considered like you should account these kind of transactions in a separately at the measurement stage only, at the initial stage only. So this we should identify them. Say what is the normal credit period cost, and then what are the interest element in it. We should identify at initial stage only. Say in this situation, on the recognition date, there are two part. One is principal portion, one is interest portion. How they are asking to identify as per Ind AS 16. First, we should ask. See, if it is a normal credit period, it would be 100 crores only. So that is the principal case. So that is the actual principal. That the extra 10 crores is interest. So that interest you should account under the under other cost, not an PPE. So I will give one example also. I mean, I will write one accounting entry. You will identify that on the recognition date and 1 year and all. So first of all, you identify the dates and all. Recognition date, payment date, and year 1 crore and 110 crores for normal credit period and behind the normal credit period. And then the payment date would be after 1 year. So what we need to do? First, we need to account on day one initial cost, the PPE 100 crores, two payable to vendor 100 crores. The actual transaction is 110 crores, right? That will come. And the day two, the depreciation and all will come. And then the year end. For this payable, you might have to pay interest also. If you calculate that interest, that will come to say suppose 10% interest cost. The difference also 10 crores only, right? So that's why I can taken 10%. So interest cost 10 crores to payable or interest payable credit 10 crores. Then what is your total payable to vendor? 110 crores. So what is your PPE? 100 crores only. What is the balance 10 crores? It's the finance cost. Finance cost. It is a finance cost. So it will account under P&L below the under the particular head of transaction. So sometimes these 10 crores element and these normal dates and credit dates they will not give. So they will give in the question they will give in a different manner. How will they will give? They just give 3 to 4 installments or 3 equal installments like that. Say suppose they don't mention this date and all. So the transaction would be like this. The value is 100 crores. We need to pay that 100 crores in 3 installments. Say suppose for calculation, easy calculation purpose, you will take 120 crores. The transaction value is, this is an example, no? We can use how it is, or whatever you want. So 100 crores is the PPE value. So the particular person, the what we call this guy, the vendor will give this in 12 installments. 12 installments, 10 crores each. So you will pay this in 12 installments. So in those situations, we should calculate present value based on the incentric interest rate, based on the incentric rate. Say suppose cash flows. So in SFM, you all are experts in that to calculate this cash flows. If you don't know this year, there are 1 to 12 months, right? In these 12 months, each year you need to pay 10. Each month you need to pay 10 crores, and this is the repayment value, right? And what is the interest rate on this 1 year rate? So the interest rate is 10%. Example. And if you calculate present value 0 0.9, 0 0.8, 0 0.7, 0 0.6, this will come until this 12 months. And you calculate the present value of this installment, it will come 9 crores, 8 crores, 3 crores like that. So if you add all this cost, it is coming 100 crores. So the present value of the your discounted cash flows of for next 12 months is 100 crores. Then here I will you account. So you note this 100 crores for accounting entry. I will explain the transaction. So on day one, the PPE cost is 100 crores to payable to vendor 100 crores. And then 10% and the month end interest account debtor to pay interest to payable 1 crore or 1 crore. What is the interest payable you are coming? 1 crore will come. Like that, you will pass the entries for 12 months. So in the day 12, it will come. I mean 10, 1 crore, 1 crore, all 12 months will come. 120 crores will get. So, sorry, 10 crores, 10 crores value will come. No? So balance repayment would be the interest. The 12 months portion would be there. That 120 is there. So the final entry payable to vendor 100 crores, interest payable 20 crores to bank or cash. Generally, it would be bank only because the use transaction. So this is how you account. So this is the calculation part. I mean interest part for understanding of the behind the normal credit cases. Again, in this behind the normal credit cases, you should see the recognition date and what are the normal credit period. Is there any behind normal credit period? Is there any interest part involved in this? If so, if it is in interest involved, you need to check one more checkpoint here. I will tell. First, total PP. If it is a normal credit period, it would be an cost for us. Then that would be total PPE. If it is so, the 100 crores come here. Otherwise, if you find any interest element, you should identify them as separately first. The PP is equal to total cost minus interest element. That interest element, how should you eliminate? We should calculate present value. Present value of this discounted cash flows. I mean this cash flow. Then you will get the principal portion and the interest portion. In interest portion, you need to check, is there any cost, I mean any interest portion qualified under Ind AS 23 borrowing cost. For suppose if it is qualified under the borrowing cost, you should identify them as an PPE again. If it is not qualified under the borrowing cost, then you will straight away expenses of under the finance cost and account them in the P and L account straight away. So this is the new point. I didn't cover this in example because you will get more confused if I cover this point also. But you should remind this point while if any transaction is not the normal credit case. So if it isn't behind normal credit periods, then there would be two elements come say there. Then PPE part will come, then principal portion, and then interest portion. In that interest portion, is there any cost covered under the Ind AS 23? If it is covered under the Ind AS 23, it will come as an PPE. Again, if it is not covered the Ind AS 23, it would be the interest cost or finance cost straight away. So I hope you understand this standard till now. And then the next concept. So students, ICAI will not ask this kind of question till now. I mean, they just ask interest portion and principal portion verification. They didn't include borrowing cost till now in the examinations. Either they will ask borrowing cost plus PPE asset or PPE or finance cost asset. If they merge, if they want to cook student in more, so they will ask this kind of questions. So you should be ready with all kind of concepts in the S23. And then if you acquired an asset in a non-monetary or both asset, I mean to say, if it is an monetary plus non-monetary asset or only non-monetary, not if it is a monetary asset, no, it should directly covered under the this part. I mean the measurement part and all. See what is monetary mean? Easily convertible in cash. There is a monetary. Non-monetary asset means not easily convertible under the cash. So I mean the bank receipt checks. So these are the monetary benefits. I know. I hope you understand this. So if it is a directly monetary, it should not cover here. It's a non-monetary asset, and both assets should be transacted. Suppose you have one vehicle one, and you transfer that vehicle one to your friend. He is doing a separate business, and you get this vehicle two from his business. So this vehicle, these are the non-monetary transaction, And then apart from this, you pay 10 lakhs also to get that vehicle too by transferring this vehicle one. So you have exchanged this one is a non-monetary asset and then few monetary benefit. So if you covered in the both cases or if you exchange only these cases, that particular transactions cover in this concept. The they will see in the next page how we account them. First of all, if any cases, if any exchange acquired by a non-monetary asset or both, I mean exchange monetary and non-monetary assets. In those situations, first we need to check commercial substance exists in the transaction. What is the commercial substance? This is the important question in this standard. So real Ind AS starts come here. All this you might have heard earlier classes also, but this is the real challenge for students or everyone. So what is the commercial substance? If any exchange of particular kind of transaction or exchange transaction changes the or affects the or significantly cash flows of the characteristics of the transactions. So cash flows, entities cash flows might have been changing at any stage, either pre-tax, post-tax, or whatever the cases. The cash flows of the entity. So if you use this vehicle one, you will get 50 crores. If you use this vehicle one, you will get 150 crores. So this is the significant change, not just 1 or 2 crores. This is a significant change by using the vehicle two. And then the entity's specific value will change significantly. Say suppose if you have an vehicle one, the customers will get for 30,000 customers you will get. If you have a vehicle two, 3 lakhs customer will get. So that value also significantly change. And there is significant change in the fair value, in the market value. If you have the vehicle two, your market value will increase. Say suppose market value of the entity or something. Say suppose what is the commercial substance means if that particular transaction as either of this, either they will change the significant cash flows or the entity's specific value and the or the fair value. If they increase them, these are changing. Change means either increase or decrease. In the reverse case, for vehicle 2 guy, this is changing, right? From vehicle 2 guy, their value decreasing from 150 to 50, decreasing their customers from 300 to 30k. The fair value from 200 crores to 10 crores, from 10 crores to 200 crores here. So this, I mean, if any significant value is changing, the change either upward side or downward side, you should identify them. If business economically different in a meaningful way, so if these changes is happen, their business definitely change in a meaningful way. Say suppose the see your customers increase from 30,000 to 300k, you should recruit more employees to service them, and you should take more vehicles, you should take more customers, you should take more infrastructure needed for to provide these kind of customers. All this will come, so your meaningful business will change economically. In that case, yes, the transaction has a commercial substance. If all these are no, the answer of these all questions is no, then that particular transaction doesn't have commercial substance. Why we need to check this commercial substance before we check the calculations? Because based on this commercial substance having or not having the particular transaction, your accounting treatment will change. Because we need to see whether do we need to consider fair value of that particular transaction or not. That will depends on the commercial substance concept. So that is why I have explaining first commercial substance concept, then we will go to valuation part. So I hope you understand this what is the commercial substance means. It means the entity specific values definitely will increase. So this is the theory part as per Ind AS. So I have given few examples here. Otherwise you can read all this from your institute material, right? So that is not our agenda. Our CA professionals may not use this and day to day. So if they listen this video, it would be helpful for them. In this case, there are few examples. Say suppose how would we identify? If you listen these examples, you may get few ideas. The truck exchange for advanced refrigerator truck. The earlier truck you do not have an refrigerator features. Now you exchanging with an say suppose you have a truck, you have a food transferring business, you have a truck, but the truck as do not have fridge facility, refrigerator facility. Then you are exchanging this truck with another guy, the new another guy with truck with refrigerator base. But this guy is doing another business. He do not have refrigerator requirement now, or he is selling business something. The party one, sorry, party one, party two. This guy has refrigerator, but he want to change it to a non-refrigerator vehicle. So they will exchange these assets. That so this refrigerator value, having the refrigerator with the truck will value the food court business, right? So it will change. The economical transaction will change here. For him also it will change. So the significantly change the value, specific value or the fair value, or these are the changing significantly. Then you can say this transaction as an commercial substance. We'll see the second example. The similar truck exchanged for another supplier. He has a truck with no refrigerator facility. The same transaction exchanged with the same kind of vehicle with another vendor. So there is no significant value changes in these cases. There is no cash flow changes. There is no economic specific values, or there is no fair value changes here. They just you exchanging your assets from one place to another place and the same features. In those cases, you can easily say this transaction doesn't have a commercial substance. I have given few examples apart from this. Let us see those examples also. See, office building exchanged for warehouse facility. Earlier, you might have using that building for office purpose. Now you can use that building for warehouse purpose. So, in office building, you could have employees of management team, marketing team, everything. In a warehouse, we have only particular department only. So the value significantly changing, and the business also economically changing from office space to warehouse. Then you can say this transaction as a commercial substance. And also telecom sector, 4G equipment exchange for 5G equipment. See the Airtel business guys, they have few towers on 4G equipment basis. They are requesting some another telecom center for exchanging for 5G spectrum. See your value, the entity's value or business value, economic value changing from 4G to 5G. This is the main feature nowadays. So this transaction can covered as an commercial substance. We can say yes, this transaction has commercial substance. What we need to do if the transaction has a commercial substance, that I will explain in the valuation part. Before that, I am explaining this and examples first. And then coal mining equipment exchanged for lithium extraction equipment. This is also business value change. These are the examples. And then airline exchanges cargo aircraft for passenger aircraft. Earlier the as, say suppose there are some aircrafts, these facility these aircrafts as cargo facility, so they will travel only with luggage. Now they are exchanging that craft with passenger facility. Now they can carry passengers plus minimum luggage. So their economic value, because the cash flows will change definitely, because in for cargo you will charge 200 per kg and all, but for economics there are business class, economic class, and the regular classes. There are separate tickets. The cash flows are changing here. So we can say this transaction has commercial substance again. And two assets generate the same pre-tax cash flows, but post-asset. See, this is main important. This is the one of the cash flows parts, and the institute has asked a few questions on this in the RTPs. Your vehicle one, vehicle two, or PPE one, PPE two. See here, your pre-tax, say suppose it will generate 100 crores. it is also generate 100 crores. This is then regular mode, and this is then EV mode. So your cost would be 20 crores, 20 crores. So your pre profits 80, 80. Till now same, but tax is 30%, 15%, because you are using EV here. So government has given tax benefit for these cases, for EV cases. In this situation, your net post cash flows, post tax benefits. Say if you remove this, say suppose 24 is, 24 is your tax value here, and then 12 is your tax value here. You will get 56 tax benefits, 68 post tax benefit. See, you're economically you are getting 12 crores benefit here while you using EV machines. For exchanging of this kind of transaction on pre-tax level, you will not getting any additional benefits, but on post-tax level you are getting 12 crores benefit. So these transactions also we can say it is as an commercial substance. So this you can understand in a easy way. Some other examples also: petrol to EV, diesel to EV, or office to warehouse, or warehouse to factory, these kinds also. And then some transfer litigation, I mean transfer development rates, or floor space index, means land summarized surrendered under TDR or FSI. These are few rights for the government. They can give your land. I mean, they acquired your land for the under these acts, and then they will give the new land to you. Say suppose they have taken off your 1 lakh square feet land, and they have given 140, like 1,40,000 square feet land. So the square feet are changing. The market value is changing for on this transaction. So in these particular cases, we can say we have a commercial substance for the because we have change in the market values, not in the commercial transactions or the cash flow benefits. The change is in happened in the market value level. So we have considered them as a commercial substance. And then few more examples we do not have a commercial substance. What are them? Land swiping. See, there are similar owners here. They just, this is 2 acres, this is 2 acres, they transfer the ownership, the same economic benefits. This is not a commercial substance. We should not, we do not have a commercial substance here. And then same type of machinery, there is no same 4G to 4G, or EV to EV, petrol to petrol. These are similar features are there, na? This is also not a commercial substance. And then boundary adjustment. Say suppose you have 2.1 acre, here also 2.1 acre, 2.1 acre. These 1 acre has some litigation problems. You exchange these boundary adjustments between the farmers. So this is also, this transaction also does not have a commercial substance. So one more example, confusing point there in this particular non-monetary item, that is government acquired your land and pay consideration. See, most of them assume that this is an commercial transaction or not commercial. First of all, this is not at all a transaction. First, this is a government acquired on a monetary. I mean, in a compulsory basis. So sometimes we have given our land to the governments for laying the roads, or for any public benefits. Or else governments itself come to us and acquire. We have 3 floors of building. I mean, 3 buildings in our portion. Government laying a road on place of one building. So all this building one gone now under the government compulsory acquisition. So we de-recognize this first, and then account under the account them as, okay, account them that consideration as in sale consideration. So this is not an non-monetary benefit or exchange of payment. It isn't compulsory exchange. First, this is not an exchange transaction. It is a separate facility. I mean, it is a sale of the building one or something. We de-recognize this building first, and if we buy any new building here, we need to account that new building under the new asset. This is not an exchange of the building one to building five. So you note this point. If they give this point, you should not assume this under the exchange benefits, and don't give this non-monetary exchange or valuation under this, so you will lose marks here. I hope you understand this. I am just highlighting this point. If any government acquired and pay consideration, it is not a compulsory acquisition. So you should dispose that asset first. You should dispose that asset. Disposal of that asset, not an exchange transaction. Similar, sometimes company gives land to the government for public uses. That is also not an exchange transaction. That is an disposal of our asset. C. Finally, we understood what is the commercial substance. I hope you understand till now what is the commercial substance. So yes, you have a commercial substance now. Then what will you do? That is the main part now. Then that we will discuss in the next class. Next class we will discuss how will account if we have a commercial substance. So uh, how we account if you do not have a commercial substance. So if you do not have a commercial substance, how will account? If we have a commercial substance, how we will account? Say suppose what is the fair values and all, what are the involved in this, and post that we can start the measurement after the recognition also. Till that measurement after recognition. After recognition, how should we measure? There are two models come now: cost model, revaluation model, and how would we account, and what are the frequency of the revaluation, and what are the accumulated depreciation treatment, and what are the revaluation timings and the values, and then what is the utilization of that surplus, how should we utilize, and how should we account, then what are the practical examples involved in it, and what is the depreciation of that items, and how will it come. All this will account, I mean will discuss in the next classes. And what is the treatment of the gain or loss under the revaluation time. In the next classes I will explain this. Till now, stay tuned. Bye bye.